Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to be discussing what a hard landing would look like. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. There's been a question that's been asked quite frequently around various social media channels and also to Powell himself, and that is, will we achieve a soft landing or will it end up being a hard landing? And Powell, of course, has not declared victory yet, right? They have not yet declared victory on achieving a soft landing. So what I want to do in this video is to walk through what, theoretically speaking, a hard landing would even look like if it were to materialize. Again, there's no guarantee that it happens. Additionally, whether it happens or not might not be useful for you as an investor, depending on what your time horizon is. These things can simply take years to play out. And what we're going to do is we're going to go through various examples in history to understand what a potential path to a hard landing would even look like. I think there is some recency bias associated with what a path to a hard landing would look like, mainly because of what happened last cycle. But what we can do is we can go look at 3 prior examples that would show you very different paths to ultimately getting to a hard landing that look extremely different than what we saw during the last cycle. So before we get started on this, I feel compelled to talk about, what I do, because I think what I do can often be different than what what I might present. What I do with investing with the S&P 500 is essentially I just buy low expense ratio index funds when the risk on the S&P is below a certain risk level. So in this case, what I normally do is when the risk is below about 0.7, 0.75, somewhere in that window, then I feel comfortable DCAing into a low expense ratio index fund. When the risk level is above that level, right, when it's above 0.75, right now you can see it's actually 0.8. When it's above that level, sometimes I'll take profits. Sometimes I will just sit on my hands. It kind of depends on if I need the money for something. Because while it is a high risk level, history shows that you can spend a long time at high risk levels before they come back down to earth. So before we go far into this video, I just want you to know that predicting, a potential path to a theoretical future hard landing doesn't necessarily have any implications on what I'm doing as an investor, because oftentimes those paths can take an extremely long time to play out. And so my strategy is to ignore all that and just say, right, when the risk level is below what I'm comfortable with, then I DCA into low expense ratio index funds. When it's above it, I stop buying, and sometimes I might take some profits. That's my strategy, okay? Not trying to figure out if and when a hard landing is going to occur. With that said, I want to spend some time in this video going over what a hard landing could theoretically look like based on examples from the past. And we're going to look at 3 main examples. We might touch base on what happened last cycle, but that's not what I want to spend a lot of time on. Last cycle, obviously, we had a black swan pandemic event, and it really changed what we have historically seen. And so I do want to go through prior cycles to try to understand what are some other potential outcomes. Now, one thing I will say when it comes to videos like this, talking about what would be a potential path to a hard landing, is we first must understand or ask ourselves, is there any evidence that would point to a hard landing? Why worry about a hard landing if there's no evidence that's pointing to it? And so let's go see, is there any evidence pointing to the idea of a hard landing, or does it not actually exist? So if we find evidence that suggests it could happen, then of course we can look at the data. Of course, there is some evidence, otherwise we'd be making this video. There's also some evidence to point to the contrary to show a fairly resilient consumer. So we must remember that first, let's look at some evidence that provides sort of the framework for it, and then we'll talk about what a potential path there could actually look like. So it all comes back to this idea of higher for longer, right? Interest rates and the lagged effect that can have on the economy. Now, if you think about high interest rates and what's essentially happened over the last couple of years, the Fed has raised rates to 5.5%. Now, about 2 years ago, I suggested that 5.5% was likely going to be the terminal rate of this business cycle. Now that we're at 5.5%, there's all sorts of predictions on where it's going to go from here. The Fed has made it fairly clear that they believe that it is sufficiently restrictive, that it is the terminal rate. I agree. I think it is the terminal rate. There are some people who I have a lot of respect for that say that the Fed will ultimately have to raise rates even higher than 5.5%. But my own interpretation is that 5.5% is sufficiently restrictive, because it's not just a matter of how high the rate is, it's a matter of how long are they willing to keep it there. So every month that goes by at 5.5% theoretically becomes more and more restrictive, primarily because as time goes on, a lot of these companies that have to refinance their debt from very low interest rate, now they have to do it at a much higher interest rate. So I think there's some illusion that every business has sort of adjusted to higher rates when a lot of them haven't even necessarily rolled over their debt from prior lower rates to the current rates that we have today. And so if that is the case, then the longer we stay at 5.5%, the more companies that have to refinance at a much higher rate. Now, I get the impression that a lot of companies are trying to delay things as long as they can, but the problem is that the Fed keeps pushing out when theoretical rate cuts might even arrive. And so what this forces is it forces a lot of companies to then take out, to basically roll things over at a much higher rate than they otherwise were hoping to do so, just simply because the Fed has actually gone higher for longer. So one of the things that we can look at, and we have to start with, is the labor market, because the labor market is ultimately what it all comes back to. And the labor market is one of these things that we talk about, and for so long it doesn't really seem to matter what it's doing, and then at some point it seems like it's the thing that everyone focuses on when you look at prior cycles. Now, this cycle so far, the labor market has been extremely resilient. But when you compare it to prior cycles, not necessarily any more resilient than we've seen in prior cycles. In fact, that might be giving this cycle too much credit to say that it's held up a lot better, because a lot of times the labor market remains relatively tight for an extremely long period of time. One thing that we could look at with the unemployment rate is to plot it against, say, I think this is the 24-month moving average. The 24-month moving average. And just as sort of a brief note here, and this is not a fundamental reason, right? But any time we have seen this metric, the unemployment rate, go above its 24-month moving average, it seems like it's only a matter of time before the unemployment rate really starts to pick up and go much higher. And I can highlight many examples where that's exactly what happened. You had an unemployment rate that basically hung out at these lows for a long time, but once it crossed that 24-month moving average, it was only a matter of 6 to 12 more months before it was really starting to skyrocket. And so when we look at a chart like this, we must remind ourselves that the business cycle simply can take a very long time to play out. We have only just seen the unemployment rate here lift off of the lows. In fact, if you were to take a time range from the low from, say, April of 2000, you will see that it did not even get above 4% for a year or so. Right here, we tagged this low here at 3.4%. that was, in early 2023. So in a lot of ways, while the labor market, and we can point to the labor market being relatively resilient, I don't know that we can actually say that it looks any different from all these prior business cycles where we saw the unemployment rate slowly climb back up, get above that 24-month moving average, and then from that level, maybe consolidate for a little bit before ultimately moving much higher. So this would be one piece of evidence to suggest that a hard landing could theoretically occur, right? Just simply the fact that the unemployment rate is moving up, it's above its 24-month SMA, and there's no clear sign yet that it's slowing down in a durable fashion. And until we go back to looser monetary policy, I think we have to be under this, approach of we have to wait and see, right? It would be premature to say that the unemployment rate won't ever go up in this cycle before the Fed starts to cut, because the idea is that the Fed raised rates to a level they think is sufficiently restrictive to slow the labor market down, to reduce wage inflation. So if it turns out they haven't actually done that, if they haven't actually slowed it down enough to cause this to start to go up, then it might just imply that wage inflation just starts to reaccelerate. So I think that that's an important aspect of this, is how do you actually solve the inflation problem without loosening up the labor market? Now, a few months ago, a lot of people were looking at inflation and sort of declaring victory on it and saying, all right, we're well on our path to 2%. And it looked like we were, right? I mean, 9% all the way down to 3%. A lot of people were saying, hey, we're good. We've beaten inflation, and there's nothing to be concerned about now. But you can see the problem is that ever since June of 2023, headline inflation has stayed flat at around 3%. So this is evidence right here that would show us that the Fed has to stay higher for longer. Because if they don't, they run the risk of getting other waves of inflation. Now, I'm sure everyone has seen all the charts circling through X or Twitter, YouTube, where everyone is comparing this current inflationary cycle with the 1970s, okay? Now, while it is true that inflation could reaccelerate if we get a lot of money printing and if we go back to looser monetary policy prematurely, it's also true that if that were to happen, it would also likely lead to a hard landing. As you can see, in the 1970s, anytime we got to a relatively low inflation rate from the peak, if it started to reaccelerate, it just ultimately meant that we were going to get a recession. In fact, it was near the time that inflation reaccelerated at the end of 1972 that the market topped out. It's pretty clear, right? As inflation started to reaccelerate, the market sort of threw its hands up and said, well, what are we going to do? We have another wave of inflation. It essentially means we need another complete round of rate hikes to get it under control. And so in this case, if the economy were to actually reaccelerate, then it would imply that we just need more rate hikes, and therefore we still cannot declare victory on achieving a soft landing. So when we think about what evidence is there to suggest that a hard landing could even occur, I think the first thing you look at is the unemployment rate and say, look, it is moving up. It's slow, but it is moving up, as we can see compared to all of these prior business cycles going back for the last 70 or 80 years. This is what we've historically seen. The second reason why we have to be at least somewhat aware that a hard landing could occur is that the Fed does not yet have the luxury to aggressively cut rates because inflation is still at 3%. They've said before they don't have to wait for it to go back to 2% to start to cut. But the problem is that it's not really trending to 2% right now. It's still sitting at around 3%, and it hasn't made much progress in over 7 months. So in that regard, I think we must say, well, seems reasonable that the Fed might stay higher for longer. The reason why that's an issue is because recessions are often induced by the Fed remaining too tight for too long. The unfortunate consequence of monetary policy is that it operates with long and variable lags. We cannot know the effects of all the rate hikes the minute they happen. We often must wait 12 to 18 months to really see those rate hikes filter through to the economy. In the same way that rate cuts don't immediately often work. I'm sure many of you guys have seen the charts of rate cuts and what the S&P normally does after that. In the same way, rate hikes don't immediately have an effect because, as we said earlier, a lot of these companies have to refinance their debt at higher rates, but that doesn't happen the minute the rates go up, right? It happens months, quarters, and sometimes even years later. So when we think about the evidence for a hard landing, there's the unemployment rate that's slowly starting to climb, and there's inflation year over year remaining relatively sticky. Now, we could look at some other things as well, and I'll provide a few other examples, and also I'll try to provide some counterexamples as well. There's, of course, the Treasury yield curve, which has been great at predicting hard landings in the past. If you look at Treasury yield spreads, you can see that the inversion of the 3-month and the 10-year yield is still very much deeply inverted, and historically, upon the uninversion or sometime during the uninversion process, that's when you can get a hard landing. This is just something that we've seen for a long period of time. And I think one of the things that happens is when you get this sort of stuff and you mention it, it can be very easy to induce, eye rolls. Just like, oh, well, someone's talking about an inverted yield curve again or something else. But again, the inversion of the yield curve historically is not a signal that a recession has arrived. It's a signal that the economy is sick, and if the Fed stays too tight for too long, they could induce a recession, which is what normally happens. There are cases where they don't induce a recession, and we will look at least one example of a soft landing. Now, there's other examples as well that we could look at. I want to take a brief look at the labor market in other ways. One of those is to look at, say, the number of states where the unemployment rate is rising when you look back 6 months ago. So if you look back 6 months ago and you look at where we are today, there are 39 states reporting an unemployment rate higher than 6 months ago. Okay? Now, if you look back in 2022, we also reached a fairly high level of 41 states, and obviously no recession occurred. This is just something to keep an eye on. Clearly, it has given false signals, as we saw the one in 2022. But it is still going up, and it's something that we should keep in mind. We could also look at unemployment at the state level, in fact. And one of the interesting things about it is if you were to look at, say, initial claims at the state level. Let me see if I can pull this up here. Initial claims at the state, let me just search for initial claims at the state level. What you'll notice is that it's very noisy, and this is why you'll often find data that's been seasonally adjusted. If you don't seasonally adjust your data, you get something that looks like this, okay? But what's really interesting is when you look at, say, like continued claims for some of these states, look at California. It's still relatively low, but one of the things to note is that it's putting in a higher high from where it was in April of 2023, right? It's putting in a higher high. This is not something that normally happens during an expansion period. Look at California continuing claims starting in June 2009. Essentially, we just kept putting in lower highs, and lower highs, and then we, of course, had the pandemic where it went up a lot, and then now we put in a high, and then it looks like now we're potentially putting in a higher high. There's other states that we can look at as well. I was looking through these earlier, and I think Nevada is one. Look at continued claims in Nevada, right? This is what it looks like during, a period of economic expansion where you're just putting in lower highs. But then look at it now, right? It just keeps on putting in higher highs. Look at what it was doing going up into the financial crisis and the dot-com crash, right? It was putting in a series of higher highs. And so that's other evidence that would at least point to the idea that it's something that we should be at least aware of, right? Hey, like this could happen. And if it does happen, you need to have a plan, right? Don't just sit there and say, who could have seen this coming? It's, there's plenty of data that would suggest it could happen. Whether it actually does happen, I suppose, will depend on the reaction function from the Fed and how aggressive they actually get in trying to turn this thing back around. So far, things are trending in the wrong direction in the labor market. It's just going at a very slow pace. If you were to look at hires, right? Hires. This is still in a downtrend, right? I mean, you can see that when it's in a downtrend, good things usually don't happen. Now, the counterpoint is that we've had a lot of excess from all the money printing in the pandemic, and that's why nothing has happened just yet. But that excess, I'm afraid, is largely gone at this point. I mean, we're back to 5.62 million new hires. That's below, right? I mean, that's below some of these pre-pandemic levels. And so I think some of that excess has actually disappeared. And you could even look in the manufacturing sector and see that new hires are plummeting right now. I mean, 327K, according to the last report. The pre-pandemic high was right a little bit above this level. And so this is the issue, is that the Fed has been successful in slowing some aspects of the labor market down, but they're not successful in actually leading to a higher increase in the unemployment rate, thereby theoretically reducing wage inflation. Now, if you don't reduce wage inflation and people continue to and wage inflation continues to outpace a headline inflation, then what it essentially means is that consumers can continue to spend and that their real purchasing power is going up. Now, again, everyone's going to argue with that, because anyone's going to say, well, if your raise is 5%, so what? I mean, it seems like everything in the world is now more expensive, and more than 5% is certainly what it feels like. You can't go anywhere without spending a lot of money. So I do think it's fair to push back on that idea some, but we must remember that as long as wage inflation continues to stay elevated, it will put upward pressure on inflation, and that's been clear with the fact that headline inflation has been flat at 3% for the last 7 months or so. So until that changes, inflation could be a formidable headwind. Now, it's not just hires that has reduced a lot. It's also job openings have reduced a lot. Down from a high of over 12 million, we now sit at 9 million. And this 9 million is not necessarily just hey, we just hit this 9 million level, let's perhaps go, maybe we'll get a bounce. This is a 9 million level that we've been sitting at for basically half a year now. And so if this were to continue to come down, which I think there's a good case to be made that it will until we go back to looser monetary policy, that some of that excess will continue to get absorbed. So new hires have slowed to a crawl. Job openings are slowing down, still not at the pre-pandemic levels just yet, but they are getting closer. And in some sectors, they have, taken a much bigger hit. Still arguably not at pre-pandemic levels. Maybe retail trade is one that was. Yeah, retail trade job openings has basically cratered here. But another area where there's been a lot of excess, and now a lot of that excess has been removed. And you would think, if you were only looking at this chart, right? If you were only looking at this chart right here, wouldn't you think the Fed would have already lowered rates? Right? Like, imagine you didn't look at the price of the S&P. If all you were looking at were job openings, and you saw, retail trade job openings all the way back down here, that would imply that the Fed is likely cutting rates to help stimulate jobs, more jobs. But they're not doing that, right? They're not doing that. And the reason they're not doing that is because their hands are tied, because inflation continues to run rampant. Remember, the reaction function of the Federal Reserve in normal times is a lot quicker than it is right now, because right now we have inflation that we're trying to get durably back to target. It hasn't happened yet, unfortunately. Job quits are also dropping, right? And again, what that means is that fewer people are quitting their job. One of the reasons for that could be simply due to they're not as confident they'll get a new job. Maybe because job openings are going down. Maybe because no one's hiring, at least in their field. And so this is something else I think we have to look at, right? Quits are going down, hires are going down, job openings are going down. So what gives, right? Why is the unemployment rate not going up? The reason, I think, is because if you look at the job openings per unemployed worker, we're still, theoretically anyways, at 1.44 job openings per unemployed worker. So if that's the case, it would make sense why the unemployment rate hasn't reacted in kind. Now, I know a lot of people are going to say that's not true. This is grossly exaggerated, but I put out a tweet earlier, or whatever they're calling it these days, and I just simply asked people for anecdotes from what does the labor market look like where they are, and there's two things I noticed. One of which, the tech sector, it seems like people are having a hard time finding jobs and they're getting laid off. So in the tech sector, it just seems like it's not a lot of openings right now. There's a lot of layoffs. And yeah, that's what's going on in the tech sector. But in a lot of the other sectors, the overwhelming response was not that people were getting laid off. It was that they just couldn't find people that wanted to work. And I'm talking about in the manufacturing sector, in retail, like in restaurants, in all sorts of businesses. I saw contractors in various areas and fields. A lot of them were just saying it's not that they want to lay people off; they just can't find people that want to work. So I think, while it might be easy to look at the job openings number and say that it's fabricated and that it doesn't make sense and that it's different because of the pandemic, it could be that the job openings, to some degree, are in areas that a lot of people don't really want to work. And maybe they don't want to work in that area just simply because they've been lured into the tech space, because that's where a lot of the money has been. So that could certainly be, contribute. And I was like trying to look at that and see if that's a common thing. And, it is. I mean, everyone, for generations, people say no one wants to work, right? Like, we're not different in that regard. Everyone will always say the younger generation never wants to work. But in terms of looking at sentiment in prior business cycles, it didn't take long, just a simple Google search. There's, an article from the end of 1999 talking about the labor shortage to continue, right? And I sometimes wonder, why is there such a labor shortage? And I almost wonder if one of the reasons is when you have a market that just goes up like this for so long, a lot of people don't want to work, right? They're just a genius at investing, a self-proclaimed genius. And I imagine it's hard for people to get off, to say get off their computer and stop trading if they feel like they're going to make more money doing that than getting a job that pays, $15 an hour or $20 an hour, right? It's going to feel like they could be more successful at doing something else. And so I think that's kind of what's going on, is that there's a huge labor shortage in the sense that there are workers, but a lot of the job openings that exist, people just don't want to do them. And the ones that people do want to do in tech, a lot of them are in tech, that's the area that is more saturated, and that's where more of the layoffs have been. I'm sure a lot of you guys have seen all these mass layoff announcements in tech, basically because that's where people want to be. They have nice compensation packages, and it's exciting, I think, for a lot of people to be in that sector. And who can blame them? The NASDAQ continues to, it's gone up for quite a long period of time. So I think if you look at all of the data, you can find examples of why we could be heading for a hard landing, right? Hires are down, quits are down, job openings are down, unemployment rate still hasn't seen that move up. But that's an issue. And if it hasn't moved up yet, it likely means wage inflation is going to continue, which means the Fed likely has to stay higher for longer. The actual truth here is that if the Fed were to pivot now or a few months ago, there would be a higher chance of a soft landing. Now, we do run the risk of reaccelerating. That's certainly a risk, and that's why the Fed doesn't do it, is because our reactionary body, they're not in the business of predicting what they think is going to happen. And I mean, admittedly, predicting what's going to happen is a very hard business to be in. But that is something that I think is worthwhile to consider, is that the Fed has to go by the data. The data shows the labor market softening up, hasn't really made that move yet. So if we believe that there's evidence to support the idea of a hard landing, then why don't we go through what a path to a hard landing would look like? Okay, now a lot of people are going to say, well, what about the counter evidence? Well, there's plenty of counter evidence. Real GDP continues putting in new highs. Though the difference between GDP and GDI continues to expand. If you were to look at, gross domestic, let me pull it up, gross domestic product right here. Let's go to inflation adjusted. So real GDP just continues going up, right? But if you look at gross domestic income, inflation adjusted, and you look at, say, like year over year, it's now negative. And so seems like for a lot of these examples, there's counterpoints to the counterpoints. If we were to go to this risk dashboard for recessions, what you'll see is that in a lot of sectors, there's still relatively low risk, right? Like real manufacturing, trade industry sales, low risk, right? Business inventories, low risk. Industrial production indices, low risk. The only thing on here right now that's really high risk is just the yield curve. Everything else seems relatively subdued. The problem is that if this stuff does become not so subdued, then the market's already starting to price that in, right? So that I think is worthwhile to consider as well, is that the risk on the yield curve is certainly high, but it hasn't propagated into the other areas that we track. So if we believe there's some evidence to suggest a hard landing could occur, let's look at 3 prior examples where hard landings did occur, not including the last one, right? Because in the last one, we had a hard landing right here induced by the pandemic. And so I think that it's silly to assume that you have to have some type of black swan pandemic occur again to induce a hard landing. What if we look at 3 prior business cycles? Okay, so we're going to start with the year 2000. And what's interesting is that there are some similarities in the sense that you first had a bear market in the midterm year where the S&P dropped about 23%. We then had another drop in Q3 of the pre-election year where the S&P dropped 12%. Does that sound familiar? Right? It's very familiar, right? It's very familiar, in fact, and it's a very similar thing over here where you had about a 26% drop, and then the Q3 pre-election year correction was about a 10% drop, right? So in that sense, it's very similar to what we saw back over here in the year 2000. That's why some people you've seen talk about, a lot of people have sort of talked about the idea of this being kind of like 1999, right? Where, the market has just melted up, and valuations on some of these companies like NVDA have just gone, far beyond what I think a lot of people would have ever thought they would have gone. And I'm certainly not in the business of trying to, to pick that top. So what eventually happened in the dot-com crash? Well, what happened is after you had this initial bear market in 98, and then you had this pre-election year correction in Q3 of 99, we then saw the S&P top out in March, right? So it ultimately topped out in March, but even though it topped out in March, it still didn't really roll over until later on that year, and we came close to sweeping that high, right? We actually got pretty close to that high in September of 2000. But what you'll notice is that it topped out just before elections. And then following elections, we then saw this massive collapse where not only did you take out the October 2020 or the October 1999 low, you also came pretty close right here in October 2001 of taking out this October 98 low, and then eventually you took out all of those lows, eventually. So if you were to try to equate it to this cycle, this area right there would be, 2022. Okay, so that area would be 2022. This would be the Q3 correction in 2023. By the way, we talked about the same type of correction last year in the S&P, that it would likely get a Q3 correction and then trend higher into the end of the year, and it did. And then so what ended up happening was it topped out in March of 2000, right? So then the equivalent would be, this would be 2024 up here, where basically the S&P carves out this high in 2024. But this, again, this was actually in 2000. I'm just saying this is what it would look like if it were to be propagated to the current cycle. And then that would mean that this low here would actually be Q1 2025. And then this low over here would be October of 2026. So that is what a hard landing would look like, right? That's what a hard landing, that's Q1 2025. This here would be Q3 2025. So that is an example of a hard landing. That's one example, and there's honestly a great chance that we do not follow what happened there. Good chance we don't. In fact, I would say it's more likely that we don't follow that than we do. I can't ever find as many analogs as there are of prior business cycles. I can never find one that actually matches another one. So why would we assume that this one will match that one? Probably won't. So that's one example. You might say, well, Ben, this is, we had high inflation. It's kind of different, but inflation was an issue back then too. In fact, if you go look at some of the articles from back then, the Fed was fighting inflation. I mean, look at inflation. It was going up. It was near 4%. It was going in the wrong direction. And then we saw the hard landing occur. Let's look at another example. Okay, that's one example. Let's look at another one. This one, we're going to look at the high inflationary period of the 1970s. And once again, you will find a bear market that ended in October, same as this year, or same as 2022, right? Think of that as your 2022. Your 20% drop. And then we got another drop later on, right? About a 10% drop. Same thing, right? This, though, occurred a little bit later. It started off occurring in October of the pre-election year, but then it carried on through March of the election year. But what you'll notice is that this top here occurred in December of the election year, right? So this is another example where you have a low in the pre-election year, in the midterms year. You have a pullback that initiated in the midterm year and finalized early on in the election year. And then you had a top that occurred in December of the election year. But the top here that occurred in December arguably occurred later than the one we saw in 2000, because the low, the 10% drop, didn't occur until Q1 of the election year, right? So it occurred 38 weeks ahead. Let me look at it on a monthly. 9 months. So 9-month difference. Right now, if you want to look at this correction here, right, 9 months from that would put you in July. So now you have two examples where you have your midterm year correction. You have another correction sort of in the pre-election year slash early election year, a top that occurred in the election year, and then ultimately a hard landing. The point of a hard landing is that it takes out the prior low, right? That's what when I say a hard landing, I mean it takes out the prior low. So you can see here, it took out the prior low. You can see over here, right? This would be your 98 low. We took out that prior low. So that's what a hard landing would be. So those are two examples. But you might say, well, what if the Fed achieves a scenario where inflation doesn't reaccelerate? Because one of the issues over here was that inflation reaccelerated. And that's actually when the S&P topped out again, is when inflation started to reaccelerate. And then you can even see this example over here from 1970 to 1973, right? Once inflation started to reaccelerate, that's where the S&P topped. So the argument is that if inflation were to reaccelerate, there's a good chance that the S&P could top, because it implies that we then have to go through another completely new round of rate hikes and we get 2022 all over again. So that's one example of if inflation goes back up, the S&P likely tops out just before it goes back up. But then you might say, well, what if inflation doesn't go back up? What if Powell means what he says and they decide not to cut until we get back to looser monetary policy, until we actually see a durable path to 2% inflation. So that's another example to think about. There's an example for that in history too. And in order to find it, you have to go all the way back to the 1940s. And what you will see in the 1940s is this example right here. And this arguably is a better example, I think, to compare to the current inflationary cycle than the 1970s. I think the 1970s, while there are a lot of similarities, I think that all the money printing that occurred coming out of the pandemic is more representative of what happened, in World War II in terms of money printing. Now, obviously, it's not exactly the same, but the result was the same, right? Something catastrophic happened, and then governments around the world just started printing money like crazy. And in that case, you can also see that we took out the low from the midterm year, right? So in this case, the election year, 1948 was 1948 an election year. 1948 was an election year. And what you'll see here, so it topped out in June of 1948. So this would be your equivalent of your 2024. This here, no, this is October of 46, right? So this would be the same thing as your 2022, right? So you got your 2022 and your 2024, and then your 2023 would be somewhere, right here, right? This is your 1947, and you even had a 10% correction in there, right? So you first got your 27% drop. Then you got your pre-election year correction. And then finally in 2024, you put in, you took out the prior low. So what we have here are three clear examples of hard landings, where the definition of a hard landing is that we take out the prior low, right? So in this business cycle, we took out the prior low. Now let's overlay the unemployment rate. I don't know if it, you can see right here, right? When did we take out the prior low? It only began after the unemployment rate started to accelerate. So you might say, well, Ben, how is that different from the 1970s? Because the 1940s was also inflationary. You said it was different. Well, it is different. And the way that it's different is that in this case, inflation at this point in the cycle, yes, there was this peak over here, but at this point in the cycle, what happened was we got into a deflationary phase. So let me draw sort of a line at around 0. The purple line, we went deflationary. And when we went deflationary, we also got a hard landing where we put in a new low. So in the 1940s, we had a hard landing when we went into deflation. In the 1970s, we had a hard landing when we had the reacceleration of inflation, right? Right here. We saw inflation reaccelerate a number of times, in fact, and every time it did, the S&P struggled for a while. So when people ask, will we have a hard landing? Will we have a soft landing? The reason why I think so many people are pessimistic, especially people that are not like me or a large part of my audience who's around my age or younger, is that a lot of us haven't really experienced a full business cycle before. So it's easy to sort of mock it. It's easy to say, who's concerned about the yield curve? Who's concerned about the labor market? It's easy just to say that the market will only ever go up. But I think there are a lot of people that would say, look, if you look at prior business cycles, We had these bear markets in the midterm year. We then had a some form of a correction that was not a full blown bear market, but just a correction in the midterm year, or sorry, in the pre-election year. And then sometime during the election year, the market topped out as the unemployment rate started to go up. And that's what we saw in every single situation, where if you, instead of looking at inflation, we overlay the unemployment rate, you can see that as the unemployment rate starts to go up, that's where the S&P sells off, right? Unemployment rate goes up, that's where the S&P sells off. Same thing in the 1940s, right? The S&P was selling off, unemployment rate was going up. So I know that it's easy to laugh at these views. I know it's easy to mock them, but I do think it would be a mistake to completely ignore them. Doesn't mean that it has to play out. And in fact, I don't really like being the guy to talk about this stuff, to be completely honest. I think to some degree, I've become the person that I used to despise, or that type of person, the more cynical, it's gonna just go into a hard landing. And I've sort of come to the realization over the years that, as a content creator, you stop making content as the hero, or you do it long enough to become the villain. I think that's true. And I do sense that, especially reading the comments. And it's certainly not as fun for me anymore, because of these views. And I also have to remind myself and others that despite having these potential views, it doesn't mean that it has to immediately affect the way that you choose to invest. For full disclosure, I've said this for a long time. I mean, what I do with the S&P is I buy at a low risk level, right? And I don't concern myself too much about whether we have a soft landing, a hard landing, or no landing. I just buy at low enough risk levels and I sell above that. When it comes to crypto, I bought Bitcoin in late 2022. I didn't buy anything else in crypto. I didn't buy ETH. I didn't buy altcoins. I didn't buy anything else. And it's easy. It's certainly easy for people to mock that and to laugh at that and to say that it was a dumb choice. And I kind of agree, that it is easy to look at that and say, yeah, I should have just gone I shouldn't have been so deterministic about my views on Bitcoin dominance. But I still can't help but look back at it and say it wasn't wrong. I mean, Bitcoin dominance has gone up a lot. And yes, there are some altcoins that have done well against Bitcoin, but I think that is more so survivorship bias than anything else. And the reason I say that is because the dominance of Bitcoin has gone up. If you follow a lot of the people that follow the breadth of the market, one of the things you might have frequently heard is how, you have the Magnificent Seven, right? Which really has been reduced down now because some of those stocks are slowly starting to lose steam. But you have the Magnificent Seven. Tesla has kind of fallen off a little bit in terms of, keeping pace. Even Apple recently hasn't been as strong. And so the case potentially is, well, what happens if you eventually get all of them not performing, and then that's where the market finally starts to crumble. At this point, it's hard to know exactly when that will be. In the 2000 bull market, the market topped out in March, but there were still some stocks putting in new highs all the way out until August. In the 1970s, right, we saw very similar stuff. And what happens, and the reason that happens, I think from a fundamental perspective, why breadth does so poorly the later in the business cycle we are, is because what happens is people don't know that these smaller companies are going to survive, right? So what do? They just pile into the ones they think can survive whatever hell's coming our way. If you look at the labor market and you if you get to the point where you resign yourself to the idea that the Fed's going to stay tight long enough to bring inflation durably back to target, then what that essentially means is they're going to stay tight long enough to break the labor market, to really turn the tables. on the labor market and to turn it from an employee's market to an employer's market. And I don't know that that's happened yet. And so if you come to that conclusion that the Fed's going to do what they need to do to get us to where we need to be, then it essentially means that looser monetary policy is further and further out. And it means that in order, as an investor, you want to basically, stay focused on the ones that you think will survive whatever hell comes for us at the end of this business cycle. And that is why the dominance of the higher market cap stuff goes up. If I had a chart here, I don't know that they have them on TradingView. Maybe we can create one, but if I had a chart of NVDA dominance, or even the Magnificent Seven dominance, it would be up a lot, right? I mean, just the high market cap stuff, they're up so much, right? They're up so much. And the other companies are struggling a lot, right? A lot of them haven't been doing well at all, and they continue to struggle. I mean, the Russell is doing okay, but it's still well below the prior highs. And I think it's really hard to know how long the Fed's going to go for before they reverse course. If you look at the dot-com crash, what do you note? What do you notice here? The Russell came back down to the lows. The S&P had a much more catastrophic drop, right? So imagine if we're kind of in this phase right here, right, where it's just sort of hopping along, and you finally do get it to drop. The thing with the drop is that when it does drop, it might not drop as much as the large caps. That's the thing about it. It might not drop as much as the large caps whenever the large caps actually drop. And we can learn lessons from that actually from the cryptocurrency market. And I've talked about this for a long time. If you look at the Bitcoin dominance in this cycle, it has been going up. So low market cap stuff has been bleeding to high market cap stuff, or Bitcoin. But do you see here where Bitcoin dominance topped in September? In September of 2019, we actually started into a bear market. It lasted for about 9 months, but it was a bear market. I mean, Bitcoin dropped 50%. But what's interesting about when Bitcoin dropped 50% back over here, when it had this 50% drop from like $10,000 down to less than $5,000, and basically it had a 50% drop if you don't even include the pandemic drop, the dominance was going down. Dominance of Bitcoin was going down during that drop. So the reason that happens is because by the time the large caps finally drop, by the time they finally give up, the small caps, they've already been decimated. So yes, they go down if the large caps go down, but they go up relative to the large caps. And that's the key thing. Look at all Bitcoin pairs in September of 2019, right? They were going up. Alts were gaining on Bitcoin during that time. Even though Bitcoin USD was going down, alts were gaining on Bitcoin during that time. And so that I think we have to remember is that, yeah, like the Russell could certainly go down and take out one of those lows. But if the market, if the Russell goes down and takes out those lows, it's probably because the S&P is starting to crumble itself. And if the S&P is starting to crumble, and it means the Magnificent Seven are finally showing some weakness. A lot of people have actually compared CSCO to NVIDIA. And I mean, you could look at some of the comparisons, right? So like this is NVIDIA this cycle. And if we were to go pull up CSCO from the 2000 bull market, of course, there's a lot of similarities, right? No doubt about it that there's a lot of similarities between this massive run up where, CSCO just kept going higher and higher and higher, and then it finally topped out. And I mean, you can kind of see that NVIDIA looks really, really similar, right? Like it just, it keeps on going up into this sort of this manic bubble mode. This run here, I mean, you can see how long, just how long it lasted. But ultimately, it topped out, right? It topped out in March of the election year, right? March of the election year. It faded until May. It rallied through the summer. And then once the elections rolled around, once we got into election season, that's when the whole thing came collapsing down. Remember Bitcoin dominance? You might say, why are you so focused on Bitcoin dominance? Well, why don't we add in ETH dominance? Okay, let's add in ETH dominance, and that'll at least get some of you guys off my back. If you look at Bitcoin dominance plus ETH dominance, what do you notice? Once we broke through this level last cycle, 73%, that's when the market started to correct. Once it broke through 73%, right now we're at 71.75%. 71.75%. We're getting close. And I think the thing that what happens is this is the same thing that you're witnessing in the stock market, right? The reason the market is up is because of a few big names. Everything else has been struggling. Yeah, like so what? Some altcoins are back off their lows, but they're still struggling. They're nowhere near their prior highs. And so what happens, I think, is it basically draws people into a sense of complacency where a lot of people here don't actually have Bitcoin. You might roll your eyes at that, but it's true. The reason we know that is because when Bitcoin dominance goes up, retail interest goes down. That's generally what happens until at least Bitcoin breaks all-time highs, right? But as Bitcoin dominance goes up during QT, retail interest tends to go down. Same thing happened in this cycle over here. So that could be an interesting level to watch. Again, this has nothing to do with what you should or should not do with your Bitcoin. I bought Bitcoin in late 2022. I converted my alts to Bitcoin in early 2022. I converted my ETH to Bitcoin in May of 2022 before the big drop, and then also at the merge. And then I think some during the drop as well. But I converted some at like 0.075, some at 0.08, some at like 0.06, I believe. But it was, it all made sense to me because I thought the ETH Bitcoin valuation was going down. So when we look at this type of chart, what's going to make it pop through here? Well, over here it was a Bitcoin rally. So I'm not here to say that it has to break one way or another. I've said for a long time, crypto portfolios, in my opinion, should be Bitcoin heavy because Bitcoin gives you exposure to the upside. So that if we continue to climb the wall of worry and the economy doesn't come crumbling down this month, Bitcoin gives you exposure to the upside. But it also minimizes your downside risk. That could change in the coming months. That could change. If Bitcoin dominance breaks 56%, I think everyone needs to be on high alert because 56% would correspond to the 0.5 fib retracement, which is exactly where it got last cycle before Bitcoin finally hit some type of local top. So I think 56% is a level that's important to get to. I still think it'll go to 60, but I think that 56% level would be symbolic. I mean, after it gets to 56%, I think 60% will probably just be a detail at that point that it'll eventually hit. But I do think that it really has to first break above this 55%, 54 to 55% barrier. If it does that, which I think it will, 56% is that target to hit. If it hits that level, I think you might really start to see altcoins aggressively bleed against Bitcoin. Just like alt Bitcoin pairs are, struggling. I think we're kind of doing the same thing. And this over here was just before rate cuts began, right? So when we talk about a hard landing, what normally happens is the market goes up into it and breadth goes down. So the number of coins in crypto keeping up with the large caps go down. The number of stocks keeping up with the large caps go down. So breadth continues to get destroyed. Then eventually, the high market cap stuff finally throws in the towel, right? In the year 2000, it was CSCO. It finally threw in the towel in March of 2000. And I don't have anything bad against CSCO. I mean, it's been in an uptrend forever. But because we had this massive bubble, everyone thinks it hasn't done that well. But what if you just ignore that, right? Like, what if you legitimately ignore this bubble and just say this is the path that CSCO has been on? That's the path. But no, I mean, because we had the bubble, now everyone compares it to what it accomplished over here. I mean, as far as I'm concerned, if you're an investor here or here, I mean, you're up. You're up. So what if there was a massive bubble? So I think something like that could happen, where NVIDIA could go a very similar way, but it doesn't mean it has to happen immediately. It could. I mean, if you look at it, I mean, it's down a little bit today, but in 2020, or sorry, in 2000, if you look at weekly candles here, in this situation over here, right? So you can see that CSCO sort of slowly climbed up into March, and then it finally dropped, right, after March arrived. So that would still be another month away. I don't know if it's going to play out like that or not. I'm sort of pointing out that the rallies have lasted a long time, and some of these smaller market cap stuff are already starting to sell off. So I think what we've done here is we've made the case that a hard landing could occur by looking at the labor market and saying the Fed's not pivoting. And if they're not pivoting, it's only a matter of time before it starts to show up in the labor market. So we've made the case that it could occur. I've shown you 3 examples of ways in which a path could materialize. One way in which inflation goes back up, like the 1970s. Another way in which the inflation goes down into deflation, like the 1940s. And then the dot-com crash, where inflation wasn't as big of an issue, but it still was an issue, and we saw the market come back down. But in all cases, in all 3 of these prior cases, we had a bear market in the midterm year. We then had a correction late pre-election year that sometimes ended in the pre-election year. In another case, it ended in the early part of the election year. And in all 3 cases, we saw a market top in the election year. So that's what a hard landing would look like. And I wonder, like from a political point of view, why that would be. And it could be because from like a political point of view, they do what they can to keep things going for as long as they can, so as to not have a recession be called before the election. And then after the election is over, and whoever's going to be in power, I mean, at that point, even if the Fed were to cut rates in early 2025, it doesn't mean that a hard landing has been avoided. I also wonder if I'm kind of getting off track, but that's the point of all this is to basically say, you know what, this is what it could look like if a hard landing occurs, right? How would it look for the stock market, right? We just went through that. How would it look for Bitcoin? Well, that's a very contentious thing to talk about, and I don't know that I actually want to talk about it. There have been people that have talked about, like a left translated cycle, so it could play out like that. That's not necessarily my base case, because I don't really want to say that like it's different this time. But if there are no larger pullbacks between now and say the summer, then that could be an increasingly probable scenario. One of the things about Bitcoin is that it tends to test the 20-week SMA every 3 to 4 months in a bull market. And once you get to the point where it's no longer testing it, it kind of like sets the clock going. And we were testing it every few months. But the problem is now we haven't tested it in 18, 19 weeks. And normally once you get past the 4-month mark, you're too far gone to hold it as support, right? Like this here was 31, 32 weeks. 2019, after getting above it, it was 25 weeks. So I would still say, hey, we're still in the window where if it drops now, we could probably, maybe we hold it as support. But if we don't test it and Bitcoin just continues to melt higher, then, maybe you get into the situation where you get some type of blow off top, either around the halving or after the halving or before the, just sometime, before the summertime or so. and then you get a larger pullback going into the second half of the year. I don't know. I mean, here I thought there was going to be a pullback, and there was, but it was pretty light, right? We did not take out this low. Here I said there was going to be a pullback after going into the spot ETF, and there's about a 20% pullback. And on Twitter, someone was saying when after it had a 20% drop, and they're like, well, when's the pullback going to happen? I'm like, what if that was it, right? What if it was just a 21% drop, just like every other correction was like a 21% drop? And they said, no, that doesn't count. Guys, you got to trade the market you're given, not the market that you want. I would love a larger pullback, but that's probably a lot of people would, and you don't get it. And like 2019, once a larger pullback actually happened, that's when the bear market started for 9 months. So look, guys, I've been in the situation before where you get into these like melt up phases where you don't test it at all for a long period of time. And anyone who ever calls for a pullback, they don't get it, or what they get are relatively shallow pullbacks, like 15, 20, 30% pullbacks. They don't get anything more substantial. And then by the time you do get it, everyone already bought in, right? And then you get a massive bear market by the time you get a larger correction. So I think that's sort of the hard part of all this, is that like, I try to be pragmatic and say, all right, yeah, like there probably will be corrections at some point, but look, I mean, the people that just keep YOLOing in, they of course have some words to say about that. And I was pretty clear over here that it might only be a 20% drop in line with all the other drops. And by the time you get a 30% drop and everyone buys it, you still probably get a bounce, but maybe it would end up being a lower high. So that would probably be the thing to look for. Whenever we get a drop that is larger than that 20 to 22% drop, that might be a sign that the tide is finally shifted. But yeah, no, I've seen these markets before where investors that try to be really cautious, and even the people that were really bullish, calling for 40K and 50K. Like I've seen some investors that were very bullish and saying that last year saying that we were going to go to 50K, and then they turned bearish, and now everyone's dunking on them. And I'm like, gosh, like it's a brutal place to be, because the minute you turn, like the minute you shift your bias away from the melt up, everyone attacks, right? Everyone attacks. And it's kind of sad to see, honestly. And I've seen people too, be very right about things for a long period of time. And then they basically get the spotlight on them. They become the main character. And once you become the main character, nothing good ever happens. Nothing good ever happens once you become the main character. Everyone watches, what you think's going to happen, and then when you're wrong, you get dunked on for forever. So I do think there's some truth into it. You basically stop making content as a hero, or you do it long enough to become the villain. I look back at my 2019 videos where I was just like so bullish on the altcoin market and so optimistic about it, and kind of like kind of ready for what was going to happen. And I just felt like the space was different back then in 2019. I feel like today on Twitter or X, I just feel like almost all of it is just people shilling meme coins and scams and getting caught out on a daily basis. And then next week, everyone forgets about it, right? They shill something to their followers, that thing goes to zero. And then the following week, they're just doing something different, and everyone still loves them because they're bullish. They're just now bullish on something different, on the next altcoin that eventually goes to zero as well. So in that regard, it certainly feels different to me right now than it did in 2019 and early 2020. I don't feel like there was as much, for lack of a better term, garbage in the space as there is now. I think there's a lot more optimism, and it wasn't just full of people getting paid to show you stuff. It was different, right? It really was. And also at the time, back over there, again, if you look at like the unemployment rate, back in, like back in 2019, like it wasn't trending higher, right? It was trending lower. Here it's starting to slowly trend higher. Like it's clearly different in terms of like that. And even here it did eventually trend higher and we got a recession. It was a black swan. I'm not gonna, go talk about it too much, but like it just seems like over here it was trending down. Here it's trending up. And every so often, as the throughout the business cycles, every so often you get into a phase where the unemployment rate skyrockets, and it disrupts sort of the natural flow of things, right? It disrupts it, and it's starting to curl up here. So going back to these things, these topics of like, well, how do you get people to work? You stay higher for longer. You make it so that these riskier assets, they take a hit, right? I mean, that's the issue, is you're not going to solve inflation without lower prices. You're just not. I mean, maybe that's what happens, is we just don't get lower prices and the stock market, and we just get another round of inflation like the 70s. It's certainly possible that something like that happens, but I think if they really want to solve it, they have to stay higher for longer to sort of get some of this rampant speculation out and make it so that these people out there, and I have no problem saying it, right? They know who they are. So they have to get those people to stop doing this stuff, right? I mean, it's painful, right? Like it really is painful, because I see so many new people to the space that come in and they just want, they want to know like how you navigate this stuff. And I'm just like, well, like Bitcoin's probably going to stick around. Like that's probably what I would say, is just stick with Bitcoin, because I don't know what's going to be here after this business cycle is over. Like I don't know. Like I have no idea. But then you got, for every one person that kind of expresses some caution, and there are some other people out there that do, I think, a good job of talking about that stuff. There's 100 people slamming the next 100x altcoin in your face. And when it goes to zero, they'll be there to do it again. So I think that's the issue, is that stuff, it needs to stop. And unfortunately, the only way to really stop it is for this to happen. Because until you really make people feel like they have to go back to work, this inflationary cycle is going to continue. Wage inflation is still going to be there. It's hard to get people to work. So that's where I think we are in the business cycle. I've made the case for why a hard landing could occur. The reasons that a soft landing could occur would be that if we just start printing again, right? If they don't stay where they need to be, if they like cut rates 100 basis points this year without some type of larger downturn in the market, then you might get a soft landing. But here's the thing about a soft landing, is that even in soft landings, they still typically lead to hard landings a couple years later. And the best example of that is probably 1967. The one main example of a soft landing that we can point to was 1967, when we had an inverted yield curve, and you had this bear market where you had an inverted yield curve, it uninverted, and then the market just kept pushing higher, but it still topped out in the election year, right? And you still ended up getting a hard landing. It just didn't really start until the end of the election year. In the dot-com crash, it started in March. In the 1940s, I don't remember when it started. In the 1940s, started in June, right? So you have three examples. One topped in March, one topped in June, one topped in December. I don't know when it's going to top, but what I would say is keep an eye on the Bitcoin dominance, because I think that gives you a lot of insight into how the consumer's doing. If the Bitcoin dominance is breaking 56%, which I think it very well could do in the coming months, then I think that's your tell that that people are becoming too complacent. We're getting too focused on a few names, and this is just what happens. And by the way, I mean, I'm not a Bitcoin maxi. For those who think that I am, it's just a natural process of the cycle, right? we're just in the phase of the cycle where dominance goes up because that's where we are in the business cycle. Unemployment rates going up. We're in strict monetary policy, etc. So I think that's where we are in the business cycle. That's why we focused so much on it. And we will continue to focus on it until there's a shift. Remember, when Bitcoin gets a larger correction, that could very well mark the top of Bitcoin dominance, just as we showed earlier with the S&P. Once it finally drops, it can take the Russell with it, but the Russell might actually go up against the S&P because the Russell's already been bleeding forever, whereas the S&P hasn't really been. So that's the case for the hard landing. Please listen to 1,000 other people and do not follow what I've said in this video as the way you're going to invest, because even I don't follow it. I stick to the risk levels, as I said before. At high risk, I sell or I hold. At low risk, I buy. I don't concern myself with how the business cycle is going to play out. Okay, it's just high risk. It's okay to take profits or hold with a long-term view in mind. Low risk, DCA and the low expense ratio index funds. That's about it. It doesn't need to be more complicated than that. I think we'll wrap it up there. Thank you guys for tuning in. Subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We'll see you guys next time. Bye.